Hi, everyone. It's Jonathan and Nick. We're joined by Jennifer at RBC, and we're meeting in the wake of the Bank of Canada making the announcement that there will be a rate adjustment. We wanted to get on top of this and discuss it with you, Jennifer, because borrowers are not necessarily always aware of the technical aspects of mortgage finance. They hear about a rate increase and they don't really know how to interpret that. So the first question we wanted to ask you is how the rate adjustment will affect people with a fixed mortgage versus a variable rate mortgage.
I think it's such a good question too, and I know the days leading up to the rate announcement, I have received a number of calls with that exact question. So if a client is currently in a fixed rate mortgage, they have no impact when these type of announcements come to be, because the Bank of Canada, when they make an announcement, it is directly related to prime bank rate. So prime lending rate is a bank lending rate. And when that happens, what will happen is it will not affect fixed, but it'll affect a variable rate. So those clients that are in mortgages that have variable terms right now can be affected, and each institution is going to take a different approach to that. So for example, at Royal Bank, your payments don't change if you're in a variable, but what will change is what goes to fixed, or so what goes to the principal amount to pay down the balance of the mortgage, and what goes to interest. But in a lot of lenders out there, it will adjust the actual mortgage payment. So that's an important thing for a person to identify, is did their payment change as a result of this? And then what is their next steps? What's their conversation look like if they have areas of concern?
Yeah, and from what I've read, apparently there's a great many Canadians who favor a fixed mortgage over variable. So based on your experience and the kind of response you've had from consumers, what would you recommend? If you're obviously you have to approach every borrower differently, their unique financial circumstances, but yeah, what would you recommend?
So I kind of equate it to how people take the stance in the market. So if, or with investing in the market. So if you're an investor in the stock market, are you a conservative investor and you go to more of like a GIC or different types of mutual funds that are not high risk? That in essence is a fixed rate mortgage. So if you can't handle fluctuations, that's always been my advice to a client is, you go to the fixed. Variable is like, again, putting money in a stock market. You're in equities, you're buying stocks, they could go up, they could go down. That's the variable rate mortgage approach. So over the last, I'd say 2-3 years, we've seen people who are more conservative shift over to the variable rate, mostly because the rates have been significantly lower than they have been in the past. So in today's world, when I look at, should you, as a new purchase transaction going into it, should you go fixed or variable? The questions I'm asking my clients are, what is your risk tolerance? But what's the nature of the property? So if it's a principal residence right now, and there's no plans of selling that, immediately in the next 5 years, fixed is not a bad route to go, because if we look at the trajectory of where the rates are going to end up over the next 5 years, you can anticipate they'll be higher than what they are today, a lot higher than what they are today. If the person is looking to sell, or an investor, I have a lot of investors that are actually still going in the variable rate, and we have to prepare for what that's going to look like over time. But it's more of that flexibility. If you want to break a variable rate mortgage, it's a 3-month interest cost in comparison to a fix, which can be higher. So I think the end result is, and you've kind of hit it on the nail on the head there, is it depends on the client, it depends on the individual, but we can also here at RBC do a combination effect where I've got people who are doing half fixed for some stability and half variable to allow for that maneuverability as well. So long and short, those that are risk adverse or worried it's going to keep them up at night, 100% fixed all day long. but unless they're going to sell. And if they're going to anticipate a sale in the next 5 years, I'm still giving that variable rate is the way to go.
Hmm. Yeah, that's interesting. And another question I wanted to pose, because it's my understanding you can go from variable into a fixed if you all of a sudden decide that you're risk averse, but can you go from a fixed into a variable? And if so, would there be penalties involved?
Absolutely. So when you, depending on your lender, and I will always say that because each lender is going to treat things differently, but majority of lenders out there will allow a conversion from a variable to a fixed at any time throughout your term. And so how that works is essentially, let's say you have 3 years left on your variable rate term that you've taken of a 5-year, you can convert it to a 3-year fixed or longer. And that will allow you to have some stability on that side. There is no penalty at RBC in that situation. You can't go the other way around though. So if you're in a fixed, you can't go to a variable without breaking that contract because it is a fixed contract, and there is no stipulation for any change like that in the contract. So you're better off probably to stay in the fixed as it is today. But if you're in a variable, you can convert to a fixed without any cost.
Okay, that's great. And how should borrowers approach their renewal with the rate adjustment announcement?
Absolutely. So great question, because for those that are in the short term, and I have this a lot right now where a person's maturity date on their mortgage is in October, November, December. And so typically with a lender, you can do up to 120 days before you can early renew your mortgage. And so if you're not with a lender, or you want to change lenders, I should say, you want to look at, maybe bringing your mortgage to RBC. If you're doing that and your maturity date is in November, December or so, rates are going to be higher then. So I'm doing an analysis for a lot of clients where it will be, well, what is the penalty if we waited until what would be anticipate, with that crystal ball that I wish I had, what's the rates going to be at that particular time? Does it make sense to break sooner than later? So a lot of those conversations are happening right now because of this change. You can always wait until maturity and then make that decision, but in today's world, that rates will be higher. So early renewal is probably the best advice from if you're staying with your existing lender. If you're exploring options, you want to have conversations sooner than later before that early renewal period to see what the cost is going to be for you to early, make that change earlier than expected, because there's going to be a penalty, but it might be worth it.
Okay. Yeah. No, that makes sense. And, there's a lot of talk we've been seeing recently. Some of our clients, that's the main reason we reached out, was they've been saying, is this not going to transition to a buyer's market overnight or anything like that? Because they read what's in the news. So how do you foresee this affecting the home prices in the near, and I guess the further term?
Yes. So we've been having a lot of talk at RBC about this exact thing. And where do we see, first of all, rates going? Like, what do we anticipate over the next 6, 8, 12, 18 months and beyond? And then obviously, what's the effect on the housing market as a result of that? So, RBC Economics has basically told us that their projections are 5 to 6 increases within an 18-month time frame. So that's 5 to 6, including the one that just happened. And that would be all tied to variable rate mortgages or prime. Okay, so that prime lending rate. So if we look at that, if there's going to be another, 1.5% potential increase, that will have an impact on individuals borrowing from the perspective of, we've got a stress test. And in previous conversations that we've had, we've talked about the stress test and things like that. Well, the stress test has always been 5.25 or the rate plus 2%. So if we have a full percentage and a half point increase on that interest rate, we're going to go beyond that 5.25% qualification. So that's going to have an impact on the market. And it will also, if we look at, obviously the interest rates themselves will have an impact on the market, because you would anticipate there'd be less activity. What we actually see in our market, so in, the Hamilton, Burlington, Oakville area, when we're looking at the projections, it can take a long time for there to be a leveling off as a result of an interest rate. So, historically, what we see is 1 percentage point or 0.25 as we just went up. It can take 6 to 18 months to see any impact of that interest rate change in the actual market. But we also have another factor that's coming in, and it's something called immigration. So we've had that border closed for a long time. And now that's going to start opening up for people to come into our country again. And where do they come? Well, they come into our market. A lot of it's in the GTA and surrounding areas. So we've got a lot of outside factors that are going to keep those prices remaining as a balance or slightly increasing. Do I anticipate a huge drop in the prices over the next while? No, I think it'll be a leveling and maybe a more, balanced market than what we see today, but not significant drops in the prices themselves. I see maybe like a softer landing, maybe like a 2-3% decrease, but that would be like, I think the extreme of it. I think will be more like along the lines of a 2 or 3% increase over existing pricing today over the next while.
Yeah, and we were feeling the same thing because we're seeing from our side of things is such a shortage of inventory. So you've got 20 buyers for every home. So until you increase that volume of listings to satiate the demand, people might have to adjust the type of property they're looking at if their affordability is affected, but they're still going to be buying.
Exactly. And I think, the key is, and we've had a number of conversations about this, the key is to understand your affordability and to start looking at homes that are below that affordability. So if you can afford $1 million home, that's your threshold. You can't go over that from a pre-approval standpoint. Then you shouldn't be looking at $1 million homes. You should probably be looking at around $800,000 homes with you guys, and really, having that ability to offer a little bit more. We may start to see that shift over the next while because of the spring market, right? With spring coming, more and more people, hopefully, I'm going to fingers crossed on this one, have homes to list, and which will increase the inventory. That will have a better approach to a person buying, and it won't be as, well, how much higher do I have to go over asking to get this house? I'm hoping that happens over the time. But in the interim, I think, making sure you understand your pre-approval and really ensuring that you're pre-approved, not just pre-qualified. There's a big difference between the two, because a pre-qualification is, what do you make? And, here's the number that you can afford. Whereas a pre-approval with somebody like myself would be, we're going to get documents, we're going to analyze, we're going to talk about not only, what can you afford, but the expenses that are going to come along with it. We're going to talk about what's plan B in the event that, you need a fallback plan. If an appraisal comes in a little differently, or you got to go a little bit over, where are we going to pull from? So a lot of questions, and why it's important to deal with professionals on the real estate side like yourselves, and with a mortgage professional like myself as well.
And that's a pretty good segue, actually. As usual, you timed it perfectly with how is this affecting the clients that you're currently working with? Obviously, if you've been in the middle of a pre-approval, or they're sitting there with a certificate and now they're a little worried about rates going up, what does that mean for them?
Yes. So I think it's a really important time to keep in touch with your mortgage professional if you have a pre-approval already in place. I had an individual this morning that purchased a home. Was one of the lucky few that has gotten a home in the last while. Well, their purchase closing date is 3 days after their pre-approval expires. So that can have a significant impact on an interest rate. So it's important to understand what's the pre-approval expiry date. So I'm talking to my clients all the time, and I normally will reach out to them, every couple of weeks or so to say, well, where are you at? How's it going? And if your expiry is going to be within 30 days and you haven't found a house, what's the impact on, extending that for another 120 days? If you do it, you lose the rate you had, but if you're not going to close within 30 days, waiting 30 more days is actually going to increase your fixed rate that much more again. So it's really important to just continue the conversation and communicate with the person who has your pre-approval, because that's a key component right now. Am I seeing more? I'm seeing an increase of the individuals, which is kind of part in part with it's spring,
Yeah.
and there's a little bit of extra, and I know it's not spring yet, but in the real estate world, this is the start of the spring market. We know, we see it every year, but I'm starting to see more and more individuals that are more, I need to do it now. I want to ensure that I've got a rate commitment in place, and it's an important thing to do. You've got to make sure, because waiting an extra day could cost you 15 to 20, 0.15 to 0.2% higher in an interest rate or more in today's world. So it's important to stay on top of it. Stay on top. If you're in the market to buy a house, you need to ensure that you know when you have to buy if you have a pre-approval, or get one in place that's going to give you that 120-day rate guarantee.
No, and that's something that we've been trying to talk to our clients about, because basically going to what you said earlier, they're only going to go up. They couldn't go any lower than they were, especially with the effect on the cost of living we've seen. So have you seen a lot of people who are trying to maybe come in now, do you think, to get ahead of any future increases? I know they're a little ways out, but has anybody talked to you about that?
Yes. So many clients are talking to me about that. And I think it's because going back to kind of the first question we talked through, is a variable rate, how does a variable rate and a fixed rate, how are people affected by if they have one or the other right now? Well, on a variable rate, it's tied to Bank of Canada again. So Bank of Canada will make another rate announcement in a few months, and then they'll make another rate announcement in a few months after that, and so on. So we're going to see that continuously change. But that's not how fixed rates are changing. Fixed rates are changing a lot more frequently than the variable is. So waiting on a pre-approval, if you want to go fixed, and a lot of people are going in that direction, again, because of the conservativeness of our society, and also, it's their primary residence and they want stability in the long term, avoiding any future increases. But waiting on a pre-approval until a week before the next rate increase, you could be half a point higher on the fixed side by then. We see it almost every couple of weeks now. Fixed rates are changing, and that's not as much broadcast out in the media as when the Bank of Canada makes an announcement. So stay on top of it as a potential buyer, to ensure that you've got the best protection for yourself going forward.
No, and we really appreciate your time, Jennifer. I think the best way to protect yourself, honestly, is to talk to someone like you, not to read what you see in the Financial Post every day and think that, that you're a guru or anything like that. You got to talk to a pro who's going to keep you posted on things, because internally, as you say, the banks do things very differently to what the Bank of Canada does.
That's exactly right. So it's just always reach out for a conversation, because what does it hurt to have the information now and then make the right decision for yourself and for your family as a borrower, instead of waiting. And you don't want to be in that woulda, coulda, shoulda boat. We want to make sure that people are informed and can make the right decision for themselves.
Absolutely, especially when they're committing to buying such a big asset as a home.
100%. But yes, thank you for having me today, and it's always a pleasure to talk to you guys.
Awesome. Thanks so much, Jennifer. Thanks, Jennifer.